Hey everyone, and thanks for jumping back into the Macroverse. We are going to continue our collaboration series. We have a very special guest with us today, Darius Dale, founder and CEO of 42 Macro. This guy knows his stuff when it comes to the Macroverse. Darius, it's a pleasure to have you here.
Ben, it's a real pleasure. Thanks again for inviting me to participate. This is awesome.
No problem. If you guys are unfamiliar with Darius, make sure you can follow him on Twitter. I will link his Twitter down in the description below and in the pinned comment. He also has his website, 42macro.com. I would encourage you guys to check this out. I've been following Darius for quite a long time now, and he's always a great voice to listen to in the space, and he always provides really interesting insights that are extremely unique, and for that I really do appreciate you, Darius. Darius, if you could provide just maybe a brief background on your sort of your introduction into the Macroverse and how you got here, I think that people would appreciate that.
Yeah, of course, man. And thanks again, like I said, for having me. So just a quick background on myself and what we do at 42 Macro. I cut my teeth in the sort of hallowed halls of institutional finance. Spent about a dozen years helping build out a pretty big investment research company since I left Yale back in 2009. Primarily what I've done was throughout my career was sort of build, very sophisticated econometric models and fly around the world explaining that to folks on the buy side in terms of, hedge fund managers, pension funds, et cetera. Since then, since COVID, I left to start my own firm at 42 Macro, and where I got sick of wearing the suits and flying around all the time, and was much more interested in actually just, building models, iterating the models, and explaining the output, and ultimately interacting with folks like you and getting to really grow this, awesome global network of investors, not just, traditional institutional finance, which are primarily our client base, but we also have a very large and growing, subscription base for the crypto universe as well. I myself fancy myself a Bitcoiner. I don't know if I'm somewhere between a Bitcoin maximalist and like maybe Ethereum, like that's kind of where I am. But I kind of approach that from a very personal belief that crypto is real democratization of finance and of resources, but also from the perspective of I don't think Bitcoin and crypto in general is really any different than trying to risk manage traditional financial markets. A lot of the same tools and processes and econometric systems that I've built here at 42 Macro that apply to the equity and credit markets, fixed income markets, currency markets, very much apply, and in many cases are actually more accurate and more valuable in the digital asset space because there's a little bit less of an institutional performance chasing feature in those markets. There will be eventually, especially BlackRock is successful with the CTF, but ultimately, I do believe we add a lot of value in this in the crypto arena. So again, definitely come check us out at 42macro.com. We have a lot of price points and a lot of products for a lot of folks, but excited to get this discussion started.
And I can echo what Darius said. They provide a great perspective on the markets, and you will not be disappointed. So make sure you guys go check out their relevant links in the description below. So to get started, we just had a new CPI report come out today. Headline inflation is down to around 3%, and core has finally broken below 5%. I'd be really curious to hear what your outlook is on inflation. Or what do you think this means right now, these reports, but also what your outlook is going forward?
Yeah, 100%. So let's just hop right into sharing some charts. I like to I think we add a little bit more value in that regard. So let's we'll get into what this slide deck here is what we call our monthly macro scouting report. Every month we publish about 100 pages of this deck's usually around 100 pages, and it really kind of helps investors understand what we call the full distribution of probable outcomes. There's the modal outcome of what we think is the most highest probability events, both from the perspective of the economy and also from the perspective of the liquidity functions within the economy. But then there's always right tail risk and there's always left tail risk. They're not always equally distributed. Sometimes the shape of the distribution changes. When you're at the bottom of the cycle, there's way more right tail risk to mismanage. When you're at the top of the cycle, there's a lot more left tail risk to manage. And so we help investors not only understand what those risks are, but also understand kind of the shape of the distribution with numbers, facts, and figures, and things that you can trust across market cycles. So let's start with inflation. And so what I'm showing in this chart is headline CPI, core food CPI, energy CPI, this is core inflation, my apologies. What I'm showing in this chart is a headline CPI, food CPI, energy CPI, and then the PCE deflators. So we'll ignore that for that because we just got the CPI data this morning. It was obviously extremely dovish. And what happened in terms of what you highlighted is that we had this significant deceleration in the year-over-year rate of change in the time series to 3%. We've seen basically almost 200 basis points come out of the time series on a year-over-year rate of change basis on inflation since, over the last couple of months. And that's been obviously very positive and supportive for the markets, because it's allowed the market to run away with this narrative that we have an opportunity to immaculately disinflate our way out of this cycle. And the reason we'll talk about later why that phrase immaculate disinflation is here to begin with, because ultimately what it alludes to is the fact that this is not a normal business cycle, and this is not a typical inflation disinflation process. You typically see disinflation well after the recession starts. And so that's headline inflation. On core inflation, we're starting to make some progress. We slowed to, I want to say, about 4% on a year-over-year basis. But to me, what the most exciting aspect of this morning's inflation report has nothing to do with the year-over-year time series. We knew that the year-over-year time series were going to decelerate because of the base effects in June were actually quite strong. But what it was most important and most exciting from the perspective of the markets and the forward outlook for right tail risks in the markets is that we have this, we're finally starting to see a little bit of a breakdown in the blue bars. The blue bars are the 3-month annualized growth rates or inflation rates of these particular indicators. And on a core basis, we saw the core decelerate 90 basis points month over month to 4% on a 3-month annualized basis. That's the lowest print we've seen since September of 2021. And if you look at super core, which is Powell's current preferred favorite metric on monitoring inflation, we slowed, I want to say a little bit over 100 basis points to 1.4% on a 3-month annualized basis, which is the lowest print we've seen since the fall of 2021. So we are now back to what Powell and other central bankers might consider, at target or slightly even below target if you look at supercore inflation. So all we have to do now, in their theory, according to their theory, is wait for the lagging indicators like shelter to catch down to where other indications of inflation are. So that was very positive. It's not shocking to me that Bitcoin is not rallying as much as the stock market today in terms of the response to this, because ultimately what this really just means is that we are going to put a cap on policy tightening from the perspective of the interest rates. This doesn't really have any bearing or impact on the balance sheet policy, which obviously crypto assets care a lot more about.
Do you think that with this recent dovish print on inflation that the Fed will continue their rate hiking cycle and QT in general, or do you think there's a chance that we get an unexpected pause at the next meeting followed by just wait and see, kind of like what we had last time?
Yeah, that's a great question. So if I were them, and that's two ways to answer the question. If I were them, I would stop. There's really no reason to continue hiking. But if you look at the spread between what's currently priced in and the Fed funds rate, it's around 20-ish basis points. And so, it's probably about an 85% probability or 80-ish percent probability that they're going to hike. And the Fed, J. Powell, Federal Reserve, is historically not surprise asset markets. Whatever's priced in for the meeting, that's typically what they do. He surprised asset markets with his words, but the Fed, his Fed FOMCs have, basically have 100% batting average of doing whatever what's priced in from the perspective of money markets. So they're probably going to hike in July. And don't forget, we did see an upside surprise in wage inflation last Friday in the jobs report. And so from the perspective of the Fed, it's not just about what the actual inflation prints are doing themselves. It's more about what their fear or lack thereof with respect to how tight the labor market is. And right now, the labor market remains it's loosening, but it remains extremely tight by any historical standard.
This business cycle is very interesting, and it does seem somewhat unique in a lot of regards, one of which, of course, is how resilient the labor market has been. Do you think that the Fed will just continue on until the labor market finally shows weakness? Do you think that they might pivot beforehand if they think that inflation is going back down to their 2% target? This is something that I think a lot of people are scratching their heads about. Like, how do we reconcile a hot labor market and getting inflation back down to their 2% target?
Well, you don't. That's the issue, and that's why Powell gets beat red every time somebody asks him about this stuff, right? In these press conferences. So no. So let's you asked a question earlier, about kind of like the tightness of the labor market and can we achieve this immaculate disinflation outcome from the perspective of the business cycle. And the reality is, let's start with why we are seeing so much resiliency in the U.S. economy going, to begin with. If you go back, many of your followers and listeners probably have seen me on different podcasts and shows and whatnot, or maybe they're even subscribed to our research. But we've been of the view since the fall of last year, since the 10-year, 3-month yield curve inverted in the fall of last year, that a recession is had the highest probability of occurring, kind of Q4 of this year or Q1 of next year. That is the modal outcome based on the historical patterns with respect to yield curve inversion and the traditional lags that you typically see with respect to an inflection in GDP to negative and a spike in the unemployment rate. It typically takes about 13, 18 months before you get to see those outcomes. So we are very much on track to achieving those outcomes. The problem with a lot of investors year to date is that they just didn't understand that the time lags with respect to some of these business cycle processes, very mundane, I might add. But going back to, why has the labor market been so resilient? There's a couple of features, right? Well, we've seen a decent amount of labor hoarding, and the reason we've kind of determined that is if you look at the labor force, we are still below trend from the 3 years after the pandemic. We are below the pre-COVID trend, the 2009 and 2019 trend in the time series, but we have recovered the trend and in a long sense recovered the trend in gross domestic income. And so if you just put two and two together, there's a lot of money sloshing around in the economy, but there's not as many bodies to create the goods and services in the economy. And so obviously as a function of that, we've seen tight labor markets, persistently strong demand for labor relative to the available supply of labor. And what we see here, you can kind of see this blue line in this chart shows labor supply, which is the total amount of folks who are employed according to the household survey, and then we add the total amount of JOLTS, the job openings as well to that statistic, and you're right around 171 million bodies in that statistic, and we're still tracking north of the available amount of labor, so the total labor force. We've seen, again, going back to the labor force here, it's been below trend for a variety of reasons, but the primary reason is that we've seen this significant drop off in labor force participation from the 55-plus-year-old cohort. Obviously, COVID was a big health threat for folks of that age, but they also probably just pulled forward their retirement. Don't forget, this is the richest generation in U.S. history. There's retiring baby boomers. They have a lot of money and income on their balance sheet, so they probably just looked around and said, "Let's start traveling instead of working." And kudos to them for that. And so you asked the question about, could we see more of this immaculate disinflation, or are we going to get trapped at a level of inflation that is very inconsistent with 2%? The answer is we don't know yet. Because right now, and the reason we don't know yet, we've never really seen such a bizarre dynamic as we don't have data for this going back many cycles. The JOLTS data starts in 2000. So, we kind of, basically everything we know about today's labor market, we can only study the data between now and 2000 to understand. And what we find is that, what's taken pressure. So down here in this bottom panel, we show this shaded area chart is the spread between the labor supply and labor demand. And so obviously labor demand has been outpacing labor supply in recent, in this post-COVID era. We're currently at 3.9 million in excess demand for labor relative to the available amount of labor supply. And that's been unusual, right? Like the only time prior to COVID that we had that was a couple of years between 2018 and 2019. If you go back to the last Fed tightening cycle and an eventual inflection in the liquidity cycle. But so, part of the reason, and so what's caused this number to go down, it peaked, this labor supply, labor demand spread peaked at 6 million in March of last year. And now we're down at 3.9 million. And the reason it's gone down is because it's only come out of JOLTS, total job openings. So we're not causing an outright decline in employment, but we are causing a decline in the need for additional employment in terms of the Fed's tightening cycle was enacted thus far. So kind of the short answer to your question is, if this pattern continues, then you will eventually get to immaculate disinflation towards 2%, because if we get back to, let's say flat here, we're going to go back to trend levels in the private sector employment cost index, which is the broadest measure of wages and salaries in the economy. If, however, we do not continue to see this and the blue line starts to hook down, once the blue line starts to hook down, they tend to be pretty non-linear to the downside, then obviously we're going to have to see a recession to get that blue line down. And the reality is none of us knows the answer. We all have hypotheses on what's going to happen to the economy. We are of the camp that we will see a recession kind of in latter part of this year, early part of next year, in terms of when that process is likely to commence.
It's an interesting business cycle, but I also think it's interesting because a lot of new people joined financial markets, out of the pandemic era, right? We're all at home, we're interested in finance, and people joined, but a lot of people, including myself, haven't really lived through a full business cycle, right? Where
Totally.
you go through the whole rate hiking cuts, or the rate hikes, the pause, the cuts. And as you said, right, it seems like we're more or less on schedule when you go by the time in which the 3-month inverted the 10-year, which I know is one of your preferred measurements, and to say that, hey, it could come as late as Q4, Q1.
Yeah.
One question I had about this is that when you look at the context of history, at least in at least during periods where inflation is not as hot as it has been this cycle, we'll see that during yield curve inversion, we don't actually typically have a recession, right? It's upon the uninversion that you actually see that recession come back. Like if you told me, hey, yield curve's inverted, are we in a recession or not? I'd be like, well, probably not. It's probably when it's, upon the uninversion. But if you go back to say like the 70s, there are periods where we did have recessions even during when the yield curve was inverted. Do you think that if we do get a recession, which does seem to be what your most likely outcome is, do you think it would likely come on the back of an uninverted yield curve, or do you think it could still occur even when we are this deeply inverted?
Yeah, that's a phenomenal question, Ben. So let's go back and kind of study the cycles. The last time we had a significant inflation episode in the U.S. economy was the 70s, obviously the late 60s to the early 1980s. And to your point, we saw these deep inversions persist well into the recessions in each of these outcomes. In fact, in the 73 to 75 recession, like most of the recession, the yield curve was inverted. And so I do believe that is a legitimate possibility in this particular business cycle. And the reason I say that is because we've already priced in a tremendous amount of rate cuts. If you look at the, so in this chart, I'm showing the blue line is the terminal Fed funds rate. The red line shows the floor Fed funds rate and how we derive those values. Or we take the OIS curve, which is the overnight index swap curve, which are swaps on the policy rate themselves, those values all the way out to 2 years. We take the max value out to 2 years, that's the terminal Fed funds rate, and the min value out to 2 years is the floor. So where does the market think the Fed is going to cut, within 2 years' time? And right now, the spread between the max value, and the min value is minus 205 basis points. And so for the curve to uninvert in a recession, early in recession, you effectively have to be saying that the Fed is going to, the Fed is actually moving faster than this implied 205 basis points of rate cuts. That number compares to minus 105 for the ECB and minus 128 for the Bank of England. So that's a long-winded way of saying the hurdle for the yield curve to uninvert very quickly early in the recessionary process is actually quite high. It's very likely that we see this, the 3-month 10-year curve invert really kind of late in the process. And that lines up with the Fed's guidance, right? The Fed has been very consistently in the higher for longer camp. They don't want the ghost of Arthur Burns, if you will, the stop-start nature of inflation back in the 70s to kind of repeat itself in this particular decade. And so we are of the view that, if you think about this from the perspective of the Fed's forecasts, right, we get every 3 months, we get the summary of economic projections in the summary of economic projections in the FOMC meeting, and they contain the Fed's forecast for GDP, core PC deflator, unemployment, and then obviously the dot plot, the infamous dot plot. But let's focus on their forecast for the unemployment rate. The FOMC sees the unemployment rate reaching a value of 4.5% by the year end of 2024. Unemployment rate is currently 3.6% now, which means the Fed is implicitly forecasting a 90 basis point delta, positive delta in the unemployment rate. Well, when you go back and you look at the history of the time series, I ask myself, has there ever been a plus 90 basis point delta in the history of this time series on an 18-month interval? So June of 2023 to December 2024. And the reality is, yeah, there have been plenty, but they've all coincided with recessions. So to me, what this signals to me is that the Fed is implicitly forecasting a very mild recession. And I say mild because 4.5 would be on the very low end of where the unemployment rate tends to rise to in recession. In fact, the median value in terms of the terminal unemployment rate during recession is 7.7%. So I think it's going to take something that looks like more than a mild recession in the data for the Fed to actually start to panic and deliver the market the rate cuts in QE that'll obviously take Bitcoin, north of 100,000 next year.
So do you think that Bitcoin could go north of 100,000 next year? Or are you saying that process could start next year?
Oh, I think by the end of next year, probably headed north of 100,000. We are in a liquidity cycle upturn. I think, the folks like myself, Michael Howe, Rob Paul, a buddy of mine, we've all have different models in terms of trying to identify where we are in the liquidity cycle. And the reality is it did bottom in the fall of last year. The process to seeing the liquidity cycle upturn has not been a smooth linear ride. But the reality is that as long as we continue to trudge forward, 3 months at a time, 6 months at a time, you're talking about a situation where Bitcoin will have the wind at its sails again. It does not have the wind at its sails currently, and the reason for that is that liquidity right now in the very immediate term is actually moving in the wrong direction. And so what I'm showing in this chart, the blue line shows our global liquidity proxy. That's the sum of the global central bank balance sheet, the global broad money supply, and global FX reserves minus gold. So that's how we track global liquidity at 42 macro. The red line shows the S&P, and these bottom panels show the max drawdown studies for those respective indicators. As you can see, we bottomed late 2022 in liquidity terms, and the market has had a fairly linear recovery since then. Liquidity had a very sharp recovery, but it's since been kind of going in the wrong direction. And that's something that we've been keen to call out. And this is part of the reason why we've seen stocks continue to rally in recent months, but we've seen kind of crypto be flat to down. If you look at things like Bitcoin, Ethereum, and you talked with your partner the other day about the altcoins, continuing to make new lows. The liquidity dries up in the fringes, and it gets the fringes excited first. Like whenever there's more liquidity, you can't buy enough altcoins. But whenever liquidity is in retreat, it's the things like the altcoin, the further you go on the risk spectrum, that tend to get hit the most in this situation. So, again, we do see this, this pattern of liquidity has been a nonlinear recovery process. It's going to continue rising longer term, but we could continue to chomp around, if not even make not new lows, if not even trend lower a bit throughout the second half of this year, because there's some more factors that are actually contributing to negative liquidity cycle developments in places like Europe, obviously here in the US.
So how do we reconcile things like risk assets in general? Like the S&P has been trending up for basically the last half year. Bitcoin, while it hasn't been doing a whole lot recently, it is still 2x off its lows. And I guess the question, of course, is if the scenario of going to 100K by, let's say, the end of 2024 is in the cards, what happens between now and then, right? Like if we get a recession, let's say Q4, Q1, which it seems to be like the most likely outcome as you discussed, do you think risk assets sell off into something like that? Like, do you think that is something that risk assets would react very negatively to, or do you think they would just shrug it off?
Yeah, absolutely. So the answer to your question is twofold, right? So we're talking about two durations, very long term, certainly from today. You're talking about 18 months between now and today. I think by Bitcoin to be over 100,000. But between now and today, between now and that 100,000, we can go from 30,000 to 15,000 very easily as a function of what we call a phase 2 credit cycle downturn. And when a phase 2 credit cycle downturn is, it's just the market pricing in a recession, which we firmly believe in our data show that the market did not do last year. Last year, it priced in the liquidity cycle downturn. And since the lows of last year, it's priced in the liquidity cycle upturn, the inflection in the liquidity cycle. So let's put some numbers on this in terms of the liquidity cycle. So we've had 4 liquidity cycles, not including the current upturn, not including the current one that started in October. We've had 4 liquidity cycle upturns since March of 2009, since the bottom in liquidity in March of 2009. On balance, on a median basis, they tend to last right around 2.5 years. And the S&P tends to be up on a cumulative basis 37% in these liquidity cycle upturns on a median basis. The NASDAQ 100 tends to be up 67% on a median basis in that 2.5 years during these liquidity cycle upturns. Bitcoin on a median basis is up not 4,826%. But again, obviously you have a lot of kind of early Bitcoin pricing in there. So if you just want to focus on Ethereum, the median upturn, the median cumulative performance in Ethereum during these liquidity cycle upturns, which is a little bit later of an entry, it's a plus 905%. So you're talking about some very positive returns from now through, let's call it the end of next year, as a function of this liquidity cycle upturn that began in the fall of last year. The problem is that along the way, you subject yourself to significant volatility if and when the recession comes. And again, we continue to be Q4 to Q1 in that view. So if you look at the max drawdowns that something like Bitcoin has historically suffered during liquidity cycle upturns, while the trend in liquidity has been higher, we see the max drawdown in Bitcoin during those 4 liquidity cycle upturns is minus 66%. and the median max drawdown for Ethereum is minus 67%. Again, so Bitcoin and Ethereum have both been, cut more than in half during liquidity cycle upturns, and that's pretty consistent across these market cycles. So it's all about just managing durations and understanding where you are in the business cycle in terms of allocating your max and min's exposure to these asset classes.
That would certainly be in line actually with what we've historically seen Bitcoin do, kind of like find a bottom 2014, 2018, 2022, kind of bounce up and then find like a double bottom or a higher low 12 months later, 15 months later. That's actually really in line with what we've historically seen. It'd be interesting if history repeated itself once more.
Yeah, no, I would expect to see, a pretty significant drawdown in Bitcoin, probably, sometime between Q1 of the next year and the spring of next year prior to the halving. The history of Bitcoin prior to in the years prior to halving is actually quite volatile. You tend to see multiple 20 to 40% corrections in the year leading up to the halving cycle. And so I don't think this year is going to be particularly, we already seen one, right? I don't think this year is going to be particularly different in that regard. But we also have something that we have yet to price in our view, is again that recession process that's likely to commence, maybe no sooner than 1 quarter, but certainly in our view, probably by 2-3 quarters.
I have a question for you because I've had this theory with crypto, and I'm curious if you think it relates to equities as well, where I don't have as much experience in. So with crypto, we've seen altcoins put in new lows, right? And actually, if you look at the altcoin market, we're now in our 4th potential red month in a row, where the altcoin market is trending down. Bitcoin has been mostly trending sideways, but it's interesting because we've seen the altcoin market bleed to Bitcoin, right? Like Bitcoin is absorbing more of that market share. Mm. And so I've had this theory that, like, as liquidity dries up, the riskiest assets get hit first, right? And they bleed to the safer ones, like the altcoins bleed to Bitcoin. Do you think that in the equity verse, I say it like that, do you think in equity markets, we've seen like large caps rally because people are going to the relative safety of plays like Apple and Microsoft and Nvidia, or do you think it's more so related to the AI boom? Like, what's your view there?
Yeah, so I mean, your theory is very consistent with hundreds of years of market history of studying the equity markets. So yeah, so typically what happens.
Tell my followers that, please.
Yeah, no. So unfortunately, if you guys are on the wrong side of this discussion, it's never too late to improve your positioning. That's something I learned from a good investor. But anyway, the going back to what we're discussing here is that you study sector and style factor leadership within the equity market, which is something we study on a daily basis or 6 times a week here at 42 Macro, because we're trying to help institutional portfolio managers, risk manage these big pivots in the markets, even though they're market neutral. So that's something we have a pretty good keen understanding in. And what we find in studying those cycles with hundreds of years of data, as far back as we get the data, Farmer, French, et cetera, is that the riskiest segments in terms of sector and style factors tend to break down, or they tend to peak well in advance of the ultimate peak of the market, which ultimately is another way of saying the market cap from those riskier sectors and style factors gets funneled into what's deemed to be less risky. And obviously what's less risky is size, mega caps. The larger companies tend to be less risky. They tend to have more diversified business models. They tend to have less leverage on their balance sheet. They tend to have more access to capital markets. And so all these things that make you more defensive in an economic downturn are all the same fundamental reasons why investors tend to flow funds into those stocks later in the business cycle. To me, it's no different. I think all markets are fundamentally driven by fear and greed, right? The reason this process happens is because people are fearful about the outcomes and what's going to happen to their riskier businesses. There's more speculative investments. And right, a speculative investment is further out on the risk spectrum for a reason. We know it's riskier. Right. And the reason, that's why we're seeking those higher ex-ante returns. You want higher returns from assets that are deemed to be more risky. And ultimately, when you think those returns aren't going to materialize, you start to rein it in. And so I think that's exactly, to your point, what's happening in the crypto space. The altcoin, the likelihood that we're going to see enough liquidity provision over the medium term, like the next 2 to 3 quarters, in terms to really get the altcoin space excited, is very low in my opinion. In fact, if we go back to this, our charts on liquidity, every month in this slide deck, we have about 20-25 charts on U.S. and global liquidity to help investors kind of understand where we are in those cycles. And one of the things we can spot, and one of the things we spot or track religiously, is kind of the trailing 3-month impulse in liquidity. And so again, as I mentioned, this is our global liquidity proxy, which is again the sum, this global central bank balance sheet, global broad money supply, and global FX reserves minus gold. We can talk about why those indicators are there, but going back to this impulse, we are minus $3.2 trillion in the global liquidity cycle impulse right now on a trailing 3-month basis. We haven't seen anything like that since kind of the latter part of last year, heading into Q4 of last year. Really, this is what we're experiencing. And so clearly Bitcoin has weathered this storm by trading flat over the last 3 months. And part of them weathering the storm, I think in our view, and I think you would agree with this, is the fact that some of that market cap from the altcoin space is flowing back up the risk spectrum, or back in on the risk spectrum towards an asset like Bitcoin.
I found myself wanting to interview you to talk mostly about macro, but now I just keep wanting to talk about crypto. I think it's really, I think it's fascinating to get, someone who's really well versed in the macro to give their views on things like altcoins, because it's not something that you can necessarily commonly find.
Yeah.
So it's really interesting, and I really do appreciate you providing insight into that. So the argument, of course, I guess, is that when the liquidity cycle begins a more sustained upturn, which eventually will occur, that's when those riskier assets up the risk curve, like the altcoins, that's when those can start to do well again, right?
Yeah, 100%. And we know what's going to drive that, right? It's all the stuff that we're looking for as investors, right? It's the spike in the unemployment rate, spike in jobless claims. You're finally going to see inflation break down sustainably below trend. And ultimately, that's, we know where we are in those processes. We track that religiously as well here at 42 Macro in terms of understanding where we are in the business cycle. So a couple charts on that. We'll talk about, our Hope plus I framework. Shout out to Michael Kantrowitz. I'm not sure if you're familiar with him, as the thoughtful macro guy. So he has this, what he calls this Hope framework that sort of tries to understand, the progression of, different cycles within the economy heading into and out of recession. And we so expounded upon that framework to include inflation, because I think obviously inflation is the most important thing to be talking about right now. And so when you look at, kind of the historical progression of these indicators, prior, leading up to and through a recession, what we tend to find is that housing, the basket of indicators that we have to represent the housing cycle over the last 12 business cycles, going to all the business cycles in the post-war era, tends to break down on right around 18 months ahead of a recession. Orders tend to break down right around kind of 8 to 10 months ahead of a recession. Production and profits tend to break down somewhere around 4 to 6 months ahead of recession. Employment tends to break down right on time, which makes sense, right? The NBER uses primarily the labor market as its primary business cycle dating tool. And then so when you look at inflation is historically been the last thing the shoe to drop prior to recession, or it tends to break down 6 to 7 months after a recession concludes in terms of breaking down below trend. And so if you look at where we are in the current business cycle, it actually, you made a comment earlier that like this has been a funky business cycle, which I agree with. Like forecasting in this business cycle has been, you have to throw out all your models, because how most models work, right? We're training them on historical data and we're using that historical training set to forecast future outcomes. The reality is this business cycle has looked very different from a delta and magnitude standpoint relative to all the recent data that we have in the economy. But it has not looked different from the perspective of the progression of the things that are occurring in the economy. And so we've seen housing break down a long time ago. Then we had orders break down. Now we got production and profits breaking down. Employment's on its way to breaking down. We suspect it'll break down sometime in Q4, Q1 of next year. And then ultimately inflation will really, kind of sustainably break down towards 2% or wherever it's going to get stuck at, maybe spring of next year. And so this looks like every other business cycle. Again, what's filtering into these charts here, into these lines here, are somewhere between 8 to 12 indicators per cycle. Again, going all the way back to as far as we can get the data to each of the post-war business cycle expansions. So the U.S. economy is a pretty consistent beast, and it's even consistent in what has been the most weird business cycle of most people's lives. And so that's that's kind of a long-winded way of saying we know what to expect. When these pink line and the blue line go down and they finally start to break down, that's when you as an investor can have a green light to anticipate significant liquidity from the Fed. The ECB would be on a 3 to 6 month lag to that, just based on their inflation dynamics and where they are in this particular cycle for the Eurozone economy, which is something we track as well. So
one of the, I think, common questions we've talked about, or people have talked about for a while now, is no landing, soft landing, hard landing. And certainly it seems like a recession would more so fall into a hard landing camp than a soft landing. Of course, if it's a mild recession, then maybe it would be categorized as a soft landing. I'm not really sure. But if somehow 3 years from now, we look back on this business cycle and it's sort of remembered as a soft landing. How do you think that would play out from here?
Yeah, so I mean, the number one thing that I think that separates this business cycle relative to previous business cycles, or at least prior to the 60s and 70s, really the 60s, is the amount of liquidity that's in the system. When you talk about cash on household balance sheets, checkable deposits, so none of this nonsense on Twitter where everyone keeps talking about XX savings this and XX savings that, and I'm like, what? It's the stupidest statistic I've heard in my career. So pardon me if I'm hijacking the program to poo-poo it. But getting back on track, if you look at checkable deposits from the flow of funds report on the private sector, particularly household sector and corporate sector, obviously, it's right around 3% of total assets, and you have to go back to the mid 1960s to see the 3% of total assets in that ratio, for the private sector. I mean, we the private sector have not been this flush with cash and feeling this rich and having this much liquidity on our balance sheets since going back to prior to the Great Inflation. And so that's kind of one dynamic that I think is really supportive. Another dynamic that's really supportive and kind of makes this business cycle process unique, and part of the reason why the Fed has had to hike interest rates so much more than was initially anticipated, why our star has gravitated higher, is because we have not seen the capital misallocation that you traditionally see ahead of a business cycle downturn. And so, one of the ways we track that is looking through the lens of private non-financial sector debt to GDP. That metric, we track it on a 5-year Z-score basis. And typically when you reach 2 on that metric, like a 2 sigma move on that metric, you're talking about, you're very close, you're very late in the business cycle. Bad things can happen. Typically when you expand credit at a very fast pace, it's usually there's some form of capital misallocation and adverse selection that is yet to be revealed, but will be revealed when the downturn happens. And so, we've seen obviously a significant degree of financial tightening through the lens of the private sector debt service ratio, but that financial tightening has sort of come without that commensurate, like growth in credit. And so we're basically, who are we tightening on, basically? And, so much debt is turned out, so much debt is obviously long in duration in that regard. If you look at the share of corporate debt that's floating rate relative to fixed rate, we're down at 30%. It used to be like 90%, a few decades ago. So like there's so much, there's so many reasons why this business cycle is unique. This tightening cycle is unique, specifically the tightening cycle. So if we have an immaculate disinflation and a soft landing, in our view, it's going to come primarily through the liquidity functions of the private sector, and also the function that we simply just don't have the credit cycle vulnerabilities in this business cycle that we've historically had leading up to recession.
It does seem like liquidity has been ample over the last year. I mean, you're still seeing all sorts of, in the riskiest assets of crypto, there's still tons of liquidity that we're seeing, and it's even surprised me. For the last year, I've actually been very surprised at just how resilient some of these riskier projects have been. I am curious though. So if the idea about a recession coming, let's say within 2 quarters or so, one of the things that is interesting to me is the S&P. Normally we see it loves climbing the wall of worry, right? Like the S&P, it's almost like, it doesn't really need a reason to go up, right? It needs a compelling reason to go down.
Bingo.
Right. And so what I can't wrap my head around is like, well, is it only going to be the labor market that brings it down, right? Of course, there's a geopolitical risk. We can't really concern ourselves too much with that because it's impossible to predict, right? But I'm curious, does it all just come down to the labor market? Like at the end of the day, is that what will finally break the back of this rally? Or, could you see the S&P fading before a recession comes?
No, I cannot. So we would have to see another significant withdrawal of liquidity akin to 2022, which is like by a country mile, like a historical withdrawal of liquidity by any measure that we have data for. You got to go back to, I want to say, like the 1800s to see the stocks and bonds down that much in 1 year at the same time. Like, so clearly 2022 was like an anomalous year from the perspective of liquidity. If you're talking about what would cause the market to go down, it is the recession. It's the business cycle downturn. I don't want to use, I want to use specific phrases, because recession is this kind of amorphous thing, but a business cycle downturn is a process. There's this process of corporates having to right size their operating structure to set themselves up to grow for the next expansion. And so, if you go back and you look at, historical, business cycle downturns, the S&P tends to decline on a median basis 24% in that process. with an interquartile range of -19 to -39%. Obviously, if the recession is deeper or more, not even deeper, it's more protracted is the issue. Then you have worse outcomes, and conversely, if it tends to be shorter in duration, you tend to have better outcomes. But it's that -19 to -39% that you need to be thinking about as an investor to having to risk manage over the next, let's call it, sometime between 4 and 5 months from now, and 6 to 12 months from now. I think that's probably when we'll see the big landing splash. So in that regard, it could be sooner. That's just based on our interpretation of where we are in the business cycle. And the reason I say it's based on that is historically the S&P tends to peak. It tends to squeeze every year leading up to the recession. Like the median return in the S&P in the year prior to recession, prior to its peak ahead of a recession, is plus 16% with an interquartile range of plus 11 to plus 20%. Sorry, plus 14 to plus 20%. So you're talking about 14 to 20%. If the interquartile range is that in the year leading up to the S&P, and it tends to squeeze right up until the very end, and the S&P tends to peak right around a month ahead of the breakout in jobless claims. So if you start to see jobless claims really accelerate in a material fashion, that's kind of a telltale sign that you're in a recession, because you're not going to know until well after the fact when the MBR comes out and dates it with the Business Cycle Data Committee. But it could take years. They didn't think we were in the Great Recession until 2009. It was like, thanks for coming out, guys. You kind of missed the wait, but thanks. So they're not going to tell you. They're not going to put the red bars in the charts or whatever and tell you in real time. So you're going to have to look at a compendium of indicators in real time to give you a sense. Okay, is this 5% correction in the stock market on its way to 20 or 25? Or is this a viable 5% correction in the stock market on its way to another, 5-10% upside before the ultimate peak? That we have dozens of indicators that we, summarize for our clients in terms of determining that.
The initial claims is something that I know people have been tracking a lot, and you mentioned it recently, and it's still trending at only like 240, 250, 240,000, 250,000. Is it going to take 300, 400,000 before we see any material change in the unemployment rate? It seems like it hasn't really made that move yet, and it could take months before it actually gets to those levels.
Yeah, no, it's a great question. So it's less, in my opinion, it's less about initial claims. We've back tested this in terms of the different cycles and what indicators are best to give you the most lead time in terms of getting in and out of the market, around these business cycle peaks and business cycle troughs. And it's actually continuing claims is the better indicator.
Okay.
Continuing claims, there's particular thresholds to analyze with respect to the speed of the change, because so much of the economy, there's fits and starts. If you're studying data too closely, which is what we do as institutional investors, you're an engineer, this better than I do. It's if you see the full distribution of data, you realize that the tails, and there's anomalies, and there's all this other stuff, right? And so much of what we have to do as investors is formulate, use our experience to know when to kind of weight certain things and not weight certain things in these mental models and in these actual models that we build. And so going back to this initial claims, there's fits and starts in the jobless claims data and fits and starts in labor market data as well. Go back to last year, we thought, consensus, saw some slowing in the labor market, and ultimately thought the recession was on the precipice. But we very much pushed against that, because we did not see the kind of speed of change that would typically historically have been associated with recession. So we're well aware what those thresholds are. We are not breaching those thresholds yet. We have some indicators of that, those dozens, probably 24, 25 indicators that we look at to kind of give you a sense of where you are specifically in the business cycle. There's some that are kind of broken down, and they're consistent with that hope framework, that hope plus high framework that we just discussed, which is all of the leading edge stuff is breaking down, but all the middle edge stuff is maybe starting to break down, which means we're, at least a quarter or two away from the lagging edge stuff that'll actually confirm a recession from breaking down.
Do you think there's any seasonality in some of this stuff? Like if memory serves me correctly, continued claims back in 2019, we also had an inverted yield curve in 2019 as well. I believe continued claims hit a local top around that March-April timeframe, just like it did this year. It dropped until around September, and then it started going back up again. And then of course we had the pandemic, which it's hard to draw too many conclusions, because everything just went up so quickly. But do you think there's any seasonality associated with some of these macro metrics, like with initial claims and continued claims, or do you think it's more so geared towards just each unique business cycle, and you can't take much away from the seasonality component?
So if you're analyzing data in the proper rate of change format, seasonality becomes less of an issue. There is seasonality on a lot of these data points, and so what the BLS and other indicator and other agencies try to do is remove the seasonality by seasonally adjusting things. The problem with doing that is that we've had this very funky, 2020, 2021 experience in the data that makes it very much impossible to use the same seasonal adjustment models to do. I mean, what I've been doing in terms of our econometric tools is just taking that out of the data set if you're trying to seasonally adjust something, because clearly that's not a seasonal pattern. That was a very one-time event from the perspective of COVID. So to answer your question, yes, there is seasonality in data. You need to know what you're looking at when you're analyzing data. Is this a non-season adjusted time series? Is this a seasonally adjusted time series? Was this seasonally adjusted time series significantly impacted by COVID? If it was significantly impacted by COVID, we're probably going to have to find a way to build our own seasonal adjustments using the non-season adjustment data. This is stuff that we do at 42 Macro for our institutional clients. And so the answer is yes, but I think taking a step back from this very esoteric discussion, it's not just about worrying about is one data point giving you giving you an accurate read on the economy. I look at I see on Twitter what's it called, Trueflation. Trueflation. They're out there saying we know what inflation is. This is the proper number of inflation. Well, the reality is no one gives a damn, certainly not in the institutional finance space, because the Fed doesn't care about that number. Right. It's about understanding what the balance of risk is as it relates to the market and market positioning, as opposed to what the right answer is. I actually don't care what the right answer is. I don't care. You think I care what GDP is going to do or what CPI is going to do or what PCE is going to do? No, I care about the rate of change and the direction of travel and the magnitude and how quickly it's traveling. And because that's where most of the information is from the perspective of asset markets and investor positioning. So, just one final thing I'll make on this point is it's always very important to have a compendium of indicators. You never want to rely on one tool or one signal to guide your overall net worth as a retail investor, certainly not your entire investment process as an institutional investor, because tools and models break. They all break. You know this better, just as well as I do. And so it's always important to have a compendium of tools, a robust set of indicators that will allow you to say, okay, this it gives me a lot of confidence that this is a turning point, or this gives me a lot of confidence that that will be a turning point.
I think the quote is all models are wrong and some are useful, right?
Exactly.
One thing you said, it actually stood out to me, and I think you actually sort of referenced this earlier. It's not about what we think, it's about what the reaction function will be, say, by coming out of the Federal Reserve, right? And earlier I asked you a question. I said, based on where CPI is, what do you think? And you're like, well, there's what I think and there's what the Fed thinks. And those can be two completely different things. So, right, we have to prepare for what we think the reaction by the Fed and other things could be not what we necessarily see going on in Trueflation, because you're right. I mean, the Fed is not, I doubt Powell is looking at the most recent Trueflation numbers to figure out if he's going to hike next month.
Not at all. Not even a little bit, man. So I doubt he even knows what Trueflation is, to be totally honest with you.
So maybe we can wrap it up on one of these final points. I'd like to give you the floor at some point just to provide some final thoughts. But one thing I'm curious about is, let's suppose that we get this liquidity cycle downturn, right? It doesn't necessarily have to put in new lows, but even if it's just trending in the wrong direction, and if a market cycle downturn, or if a downturn in the business cycle occurs, let's say Q4, Q1, and we know that risk assets like the stock market, like Bitcoin and cryptocurrencies, they don't tend to do that well. So for people that want to like hedge, right? Like, where do you look? Do you look at things like gold and silver? Do you look at bonds, right? Do you take a closer look at TLT? I know people have been getting destroyed by longing TLT too soon, and it just keeps not really going anywhere. So what's your view on hedging for those sorts of outcomes? Because it could become quite relevant here in just a few months.
Yeah, absolutely. So in terms of hedging, so hedging is about what are you trying to hedge, right? Like, and so like answering your question, it sounds like you're saying, what you're asking, what should investors be doing to hedge left tail risk in risk assets, right? Like, to me, even before we get into to answering that question, there's always a distribution of outcomes. Are you hedging left tail risk, or are you hedging right tail risk? The biggest hedge that investors needed to do this year was hedge right tail risk, because the institutional investment community, by and large, came into the year underinvested and invested for a recession that was supposed to materialize already. They were dead wrong on that. We were not dead wrong on that. We've been very consistent about our recession timing view, it being Q4 of this year, Q1 of next year. And so that right tail risk really came home to roost. And part of the reason we're seeing stocks rally so sharply is like all the short covering and performance chasing associated with that right tail risk hedging process, having to really kind of materialize. And so going back to the discussion as it relates to left tail risk, a lot of investors have really crowded into bonds and fixed income as a, kind of with the understanding that, hey, the recession is a near-term probability, and we need to find ways to A, make money at the bare minimum, protect our protect the the 60-ish style of their traditional 60-40 portfolios from. The issue, in my opinion, why bonds have not worked, and we have not been on the wrong side of bonds this year. We were on the wrong side of bonds in the first half of last year, but really learned our lesson from that mistake and have not been on the wrong side of bonds since then. And part of the reason we've understood this is because the bond market is priced to perfection already. You really need to see some very significantly negative outcomes in the business cycle, and they need to be on the tape. They can't just be on Twitter. They need to be in the reported data for the bond market to get spooked enough to kind of really reward that positioning. And so what I'm showing in this chart, this is a pretty wonky esoteric stuff. So let me kind of explain this. The shaded area chart shows the 10-year term premium. And so that's the excess return you get as an investor for locking your money in for 10 years, as opposed to constantly rolling over short-term paper, like a 3-month T-bill, for as many times you need to get to a 10-year. So that number is minus 67 basis points, which means there's an excess of demand for the 10-year relative to, what, a theoretical model would suggest to imply. You go back to the last time we had a inflation episode, we went from basically zero in the term premia to north of 500 basis points. So this number does fluctuate, and has obviously been one of the driving factors of the great moderation in recent decades prior to COVID. The red line in this chart shows market-based inflation expectations on the 10-year at right around 2.25, and then the blue line shows implied inflation expectations on the 10-year from like theoretical models of what bonds should actually be priced at. And the reality is those numbers coalesce around 2%. And so we got a bond market that's pricing in 2% inflation on the 10-year. We got a bond market that has a deeply negative term premia on the 10-year, which means in order for you to make money in bonds, you need some like significantly large left tail risk outcome that's even more left tail risky than what's currently priced into the Fed, in terms of the money markets, what we talked about earlier, right? They're already pricing in 205 basis points. Now, the median rate cutting cycle in a recession is right around 400 basis points. And typically recessions that are caused by Fed tightening, the median rate cutting cycle is right around 475 basis points. There's reason to believe that we're not going to get in my view, it's very much reason to believe that we aren't going to see that kind of those kind of outcomes. We have what we call our secular inflation model, which is designed to sort of interpolate the change in a significant, or in right around, there's 20 features in that model that are interpolating the change of all these features that have historically been very correlated or co-integrated with inflation. And right now, that interpolation suggests that core PCE, the underlying trend in core PCE, so what is the time series cycled around, is gravitated to 3%. Now, that doesn't sound like a lot of inflation, but the trend from the previous decade was 1.6%. So we're talking about a near doubling of that underlying trend of inflation. And if the Fed does not change its inflation target to 3%, what it's ultimately going to mean is that they're going to be constantly leaning against markets as opposed to supporting markets, which is what they were doing during the QE era of the previous decade. So ultimately, longer term, I do believe the Fed is going to be forced politically into a 3% inflation target, if only because they're going to be called upon to sort of take down a lot of supply from the Treasury. Don't forget the private sector, thanks to QE, thanks to banks not having the balance sheet capacity anymore, i.e. Silicon Valley Bank, First Republic Bank, and then obviously thanks to global central banks kind of walking away from the dollar at the margins in recent decades, really since 2014, you're seeing the private sector have to take down a significantly larger share of Treasury issuance in recent quarters. We at the end of 2021, the private sector owned about 36% of all marketable Treasuries. Right now, that number is 46%. So we've grown our share of marketable Treasury market 1,000 basis points in like 18 months, and that's part of the reason we saw what we saw out of the bond market last year. There are no buyers. We are more price sensitive buyers than all the rest of the other buyers are. The Fed's not price sensitive. Foreign central banks aren't price sensitive. You can make the case that commercial banks aren't price sensitive because of the Basel risk weightings on those securities. And so that when you think about this from a longer term perspective, the Fed, if they're constantly anchoring on getting the economy back to 2% inflation, they're not going to be expanding their balance sheet at a rate that is really commensurate with what the Treasury needs it to do from the perspective of the projection and the budget deficit. So I think they are going to 3%. They're going to need a recession to do it, and they just might get one in the first half of next year.
You look back in history, it certainly seems like, watching what the Fed does as opposed to what they say is a lot better, because, they'll say all sorts of things, right? But when the political pressure comes, and it probably will come. I mean, next year's an election year. We certainly could see something like that again, and I think it'll be interesting to see if it plays out like it has.
Although I will say the last two election years though were 2020 and 2008. So, or sorry, last two big presidential election years. Or sorry, let me take that back. We've seen very deep market corrections in a presidential election year is what I meant to say. Obviously, 2000, we've seen 2008, we've seen 2020. So I wouldn't anchor on that as a reason for the Fed to pivot, i.e., the political pressure from DC. The pressure is not political from DC or from the White House or from Congress. The pressure is from the indicators that they told us to focus on, right? Like, the labor market's breaking down, and they're going to get pressure from the academic community, the buy side, et cetera. The Treasury's going to pressure from the Treasury Borrowing Advisory Committee. The Fed's going to get pressure from these Fed listens events and all this stuff in the press conferences and at the FOMC. So there is political pressure from the broader populace. It doesn't necessarily have to be emanating from DC, because ultimately, I don't think the Fed is a particularly political body in that regard, but I think they're a political body with respect to how they interact with the general public. They want to be liked, just like everyone does.
Right. Yeah, that's true. And of course, they do have a dual mandate, right? It's not just inflation; it's also the labor market. And if the labor market starts to go, then
they got to pivot.
Right. They're gonna have to do something to show that it's a dual mandate and not just to get inflation back down, I guess. Darius, we've been going for about an hour here. I want to give you just sort of like a closing statement if you can make. But if you guys are watching this and you're not following Darius on Twitter, make sure you do so. Again, link to that will be in the description below. Also, make sure to check out his website at 42macro.com. Again, links all for that in the description below and the pinned comment. Darius, I'll just give you the closing statement here. What do you think? What do you think the most important takeaways here for investors are as we navigate, say, like the rest of this business cycle?
Yeah, absolutely. So thanks again, Ben. I appreciate being able to connect with your audience. Hopefully they get learn some things about cycles and risk management and all that stuff. Just in terms of like from a what to do with all this information in your portfolio. So that's risk management is where we really specialize in at 42 Macro. We don't just have these macro thoughts and macro opinions. It's about what do I actually do from the perspective of managing my own money or managing institutional client money. And so in terms of the key takeaways, we think we're about 1 to 2 quarters away from the start of a recession. Markets tend to peak, looking at S&P, right around a month ahead of that process. And so if you're saying a recession is going to start in, let's say, in December, you're talking about a market that could peak in October, maybe even at the latest, or November. If you're saying a recession that's going to start in, let's call it February of next year, you're talking about a market that's going to peak in December, maybe even January. And so that's in terms of the S&P. As it relates to crypto, crypto is a much different asset class. Liquidity is what drives the crypto asset class. There's other factors that drive, the other asset classes. Obviously, liquidity is being one of them with stocks and credit. But cyclical growth expectations drive equities. Structural growth expectations drive equities. Inflation and cyclical and structural inflation expectations drive equities and credit as well. There's all these other factors that you need to be abreast of as a risk manager in these more traditional TradFi markets. But in crypto, it's really the liquidity cycle. And so in terms of understanding where we are in the liquidity cycle, we are currently in a liquidity cycle upturn. Those upturns tend to last 2 to 2.5 years. So that kind of puts you in, late 2024, early 2025 of when we'll see the peak of this current liquidity cycle upturn. But one thing that's been very different about this liquidity cycle upturn relative to the previous ones is that it has not come with kind of a linear recovery in public sector liquidity provision. And what I mean by public sector liquidity provision is central bank balance sheet expansion, fiscal deficits as far as the eye can see, and those being monetized by central banks, much like what we saw in 2020 and 2021 and in previous liquidity cycles. That is not happening in this particular cycle. What's really driving the bus on the liquidity cycle here that's kind of offsetting some of the QT dynamics that we're seeing is this decline in the dollar. So in this chart I'm showing, going back to those charts we were showing earlier, our global liquidity proxy, which again is the global central bank balance sheet, global broad money supply, and global FX reserves minus gold. We show that number on a year-over-year rate of change basis in the black plot. What you see is almost perfectly inversely correlated is the global real effective exchange rate, which is just the dollar's real effective exchange rate on a year-over-year basis. And so one of the things that's been offsetting QT in the US, QT in Eurozone, obviously the policy tightening cycle, although I don't think rates matter as much to crypto as they do in other asset classes because there's really no valuation. Rates would matter if there was a valuation in the crypto asset class, but there isn't. And so that's why it doesn't matter as much. And so liquidity is really the only feature. And so if we can continue to see dollar weakness, and today's a huge big day for the dollar. We're breaking below the 50% Fibonacci retracement level from the January 2021 through September 2022 bull market. If we break through that level, it's an indication that we may be on the precipice of another major leg down in the dollar. If we have another major leg down in the dollar, you're going to see a rise in this black line and a rise in global liquidity. If the dollar stabilizes at or near these levels, then what's going to continue to happen is that we're going to continue to see liquidity siphon out of the system, albeit at a much slower pace than it has in recent months, in our view. China's going to come back online from the perspective of liquidity provision as well in this summer and into the fall. So there's some offsetting factors in liquidity, but I just want investors to realize that unless the dollar is going down at a pretty material pace, this black line will have a very nonlinear process. And in fact, we could see it go down pretty significantly in the winter when the private sector liquidity portion really starts to wane, right? It's not just about the public sector, it's about the private sector as well. It's about how banks are growing their balance sheets, how non-bank financiers are growing their balance sheets as well, and ultimately how does that money filter through the economy. So there's a lot of stuff to watch, but that's kind of a long-winded way of saying you're probably going to see S&P outperform Bitcoin over the next 6 to 9 months, in our view. And ultimately, I do believe from whatever peak the S&P reaches, you're talking about a market that's going to be down let's use the interquartile range to be specific, a market that's going to be down, stock market, 19 to 39%. Bitcoin's probably going to be down several multiples of that in that business cycle process. But ultimately, those are big buying opportunities. If you're a prudent, thoughtful investor, certainly if you're someone who's taking advantage of, the fact that consensus was dead wrong in this recession view year to date, you have some cash to invest. And so, the prudent thing to do would be just give it a few more months, maybe 1 to 2 more quarters before you start to see a lot of that weakness that we expect you to be able to buy into ahead of what I think is going to be a raging bull market in crypto in 2024.
Darius, pleasure to have you here again. Again, make sure you guys go check us out. Go check out his Twitter, 42macro.com, as well as his website. Thank you, Darius, for coming on here, and I will hopefully have you back on here maybe in about half a year or so we can see if we've made any progress in the business cycle.
Yeah, I was saying let's do this again in like December or January.
Sounds good. We'll see you next time.
Appreciate you, Ben. Thank you so much.